Top 3 BlackRock Dividend ETFs with low expense ratios. Welcome to WealthEchelon, your go-to destination for expert insights on finance, stocks, and ETFs. Our mission is to empower you with the knowledge and strategies needed to navigate the financial markets with confidence. Whether you're a beginner looking to build a strong investment portfolio or an experienced investor seeking market trends and analysis, we've got you covered. Join us as we break down complex financial concepts, explore market opportunities, and help you climb the ladder to financial success. Subscribe now and take control of your wealth journey. Whether you're new to investing or a seasoned pro, creating a diversified portfolio with dividend-paying ETFs can be a game changer for generating passive income. But with so many choices, it can be hard to know where to start. That's why we're diving deep into BlackRock's top 3 dividend ETFs, HDV, XHU, and BIDD. Each of these funds has its unique advantages depending on your investment goals, whether that's focusing on stable U.S. companies with reliable dividends or tapping into global markets for additional income streams. In this video, we'll not only explore the fundamentals of each ETF, but also break down the risks, potential rewards, and how they fit into different types of portfolios. From their low expense ratios to their solid growth track records, we'll help you make an informed decision on which BlackRock Dividend ETF is best for your financial strategy. Stay tuned as we uncover key insights to help you maximize your returns, minimize your risks, and build a steady income for years to come. iShares Core High Dividend ETF, HDV. iShares Core High Dividend ETF, HDV, is a well-regarded exchange-traded fund that seeks to track the performance of the Morningstar Dividend Yield Focus Index. This ETF is designed for investors seeking a steady stream of income from high dividend-paying U.S. companies. By focusing on large-cap stocks with robust fundamentals and a history of stable dividend payouts, HDV aims to provide a solid and reliable source of income while maintaining the potential for moderate capital appreciation. The ETF's selection criteria emphasize companies that not only offer attractive yields, but also exhibit strong financial health, ensuring that the dividends paid out are sustainable over time. HDV's investment portfolio is diversified across sectors that traditionally offer stable and consistent dividend payments, such as energy, healthcare, consumer staples, and utilities. This diversification helps to minimize sector-specific risks while allowing investors to benefit from the performance of well-established companies. Notable top holdings in HDV include industry giants like ExxonMobil, Johnson & Johnson, and Procter & Gamble, all of which are leaders in their respective sectors and are known for their strong dividend policies. One of the standout features of HDV is its low expense ratio of just 0.08%. Compared to many other dividend-focused ETFs, this fee is relatively low, meaning investors can keep more of their returns. Low expense ratios are crucial for long-term investors, as even small fees can compound and significantly reduce net returns over time. Over the years, HDV has demonstrated solid performance, with an average annual return in the range of 7 to 10% over the past decade. This growth is driven not only by capital appreciation, but also by the dividends paid by the underlying companies. As an example, if an investor like Martin had invested $10,000 in HDV 5 years ago, assuming an average annual return of 8%, that initial investment would have grown to approximately $14,693. This return includes the reinvestment of dividends, which significantly boosts the overall return over time. The consistent income generated by the ETF's dividends makes it especially attractive for income-focused investors, such as retirees or those seeking passive income. iShares US High Dividend Equity Index ETF XHU. iShares US High Dividend Equity Index ETF XHU is an attractive investment option for those seeking a balanced approach of regular income generation and long-term capital appreciation. By focusing on U.S. companies with high dividend yields, XHU offers exposure to sectors with a history of consistent dividend payouts, including financials, utilities, consumer staples, and healthcare. These sectors tend to be more stable and less volatile, making the ETF a good choice for conservative investors or those looking to add diversification to their portfolios. The ETF's holdings include large, well-established companies like Coca-Cola, Pfizer, and Verizon, which are known for their reliable dividend policies. These companies tend to perform well even during economic downturns, as their strong market positions and steady cash flows allow them to continue paying dividends, even in challenging times. This focus on high-quality dividend-paying stocks helps mitigate risks and provides a sense of stability in uncertain markets. In addition to its low expense ratio of 0.08%, which is ideal for long-term investors looking to minimize fees, XHU's performance has remained strong, reflecting the steady growth of U.S. dividend stocks. Historically, the ETF has delivered average annual returns of 6 to 9%, which is impressive given its focus on income-generating stocks rather than high-growth equities. For instance, a $10,000 investment made 5 years ago with an 8% annualized return would have grown to about $14,693, with dividends contributing significantly to the overall returns. The combination of capital appreciation and steady income from dividends makes XHU a strong contender for investors seeking both growth and income. One of the key advantages of XHU is its ability to provide income even in volatile market conditions. Dividend-paying stocks are often seen as a defensive play because they provide investors with consistent cash flow, which can be particularly appealing during periods of market downturns or economic uncertainty. While growth stocks may face higher volatility, dividend stocks like those in XHU tend to offer more stability, making the ETF suitable for income-focused investors, retirees, or anyone looking to build a reliable income stream over time. Additionally, XHU offers the benefit of diversification across various sectors, reducing the potential impact of any one industry's downturn. By holding a wide range of stocks from different sectors, the ETF minimizes the risks associated with sector-specific challenges, providing a more balanced exposure to the U.S. economy as a whole. This diversified approach is essential for investors who want to avoid putting all their eggs in one basket and seek a stable and sustainable income source from a variety of reliable companies. BlackRock International Dividend ETF, BIDD. BlackRock International Dividend ETF, BIDD, focuses on providing exposure to international stocks with attractive dividend yields, offering investors the opportunity to diversify beyond the U.S. market. This ETF targets companies with strong dividend histories and stable financials from regions such as Europe, Asia, and other global markets. BID's portfolio includes well-known international companies like Nestlé, HSBC Holdings, and Toyota, which have a long track record of consistent dividend payments. By investing in a broad range of global companies, BIDD provides geographical diversification, reducing reliance on the U.S. market and spreading risk across various economies. BID has a higher expense ratio of 0.61% compared to U.S.-focused dividend ETFs like HDV and XHU. This higher cost is primarily due to the additional expenses involved with international investments, including currency exposure and managing global assets. Despite the higher expense ratio, BIDD's international exposure adds significant value, especially for investors looking to diversify their portfolios globally. Historically, BIDD has delivered average annual returns in the range of 5 to 8%. For example, if Martin had invested $10,000 in BIDD 5 years ago, with an average annual return of 7%, his investment would have grown to approximately $14,025. While BID's returns are slightly lower than those of domestic-focused dividend ETFs like HDV and XHU, the global diversification it provides makes it an appealing choice for those looking to reduce exposure to the U.S. market and benefit from dividend opportunities in other parts of the world. The ETF's international scope helps investors tap into different market cycles and economic conditions, further enhancing its value as a long-term investment strategy. Comparative analysis and conclusion. Expense ratio comparison. HDV 0.08%, XHU 0.08%, BID 0.61%. Conclusion: HDV and XHU are more cost-effective than BIDD. Investment portfolio. HDV, U.S.-focused large-cap dividend stocks. XHU, U.S. high-yield dividend stocks. BIDD, international dividend-paying stocks. Conclusion: investors seeking global diversification may prefer BIDD, while those focused on U.S. markets may choose HDV or XHU. Growth potential with $10,000 investment. HDV, $14,693 after 5 years, 8% return. XHU, $14,693 after 5 years, 8% return. Bid $14,025 after 5 years, 7% return. Dividend yield and income potential. All three ETFs focus on dividend income, but there are key differences in terms of their geographical exposure and income potential. HDV and XHU are more U.S.-centric, providing a stable source of dividends from well-established, high-quality U.S. companies. These ETFs are generally less sensitive to global market fluctuations, offering consistent and reliable income streams for investors seeking stability. On the other hand, BID's yield may fluctuate due to factors like currency exchange rates and international market conditions. As it invests in companies outside the U.S., the performance of BID is more influenced by global economic factors, which can introduce some volatility in its dividend payouts. However, BID offers valuable international diversification, making it an attractive choice for those seeking exposure to global dividend-paying companies. Investors seeking stable, U.S.-based dividends may prefer HDV or XHU due to their focus on high-quality, dividend-paying U.S. companies. These ETFs offer a more predictable income stream. For those looking to diversify and gain exposure to international markets, BID provides an opportunity to tap into global dividend income, though it may come with more variability due to currency fluctuations and international market conditions. For an investor like Martin, the choice depends on investment goals. If the focus is on cost-effective U.S. dividend growth, HDV or XHU are excellent options. If international diversification is important despite the higher expense ratio, BIDD can be a suitable addition to the portfolio. A well-balanced approach could involve a combination of these ETFs to optimize dividend income and capital appreciation over time. That's it for today's video. If you found this helpful, don't forget to like, subscribe, and turn on notifications so you never miss an update. At WealthEchelon, we're all about helping you navigate the world of crypto, investing, and financial growth. Have any thoughts or questions? Drop them in the comments below. I'd love to hear from you. Stay sharp, stay invested, and I'll see you in the next one.